Dream big, plan smart, build wealth. This is the TFS podcast, where money talk gets real and financial freedom is more than just a goal. Without further ado, let's dive in.
Hi guys, and welcome to another episode of the TFS WealthCast. Now before we begin, let me ask you something. If you had $500,000 to invest in property today, would you buy one property in Melbourne or Sydney? Or would you buy two properties in regional Australia, which will give you better rental yield, which has lower vacancy rates and stronger infrastructure investments? Now, most people haven't even considered the second option. And that's exactly why we are doing this episode today. Today, we are going beyond big cities. We are talking about regional property investment, the opportunities, the risks, the data, and the real numbers. Because the smart money is already moving, and if you're not paying attention, you're going to miss out. As always, I'm Vishy, and joining me today is our founder and director, Mr. Pramu Rodrigo, senior finance broker, property investor, and someone who's been placing clients into regional markets long before it became fashionable. So as always, welcome back to the show, Pramu.
Thank you for having me.
No worries. So Pramu, are we going to jump straight into it? I know you've got your facts, you've got your research, you've got the hotspots.
Yeah, we did talk about we're gonna drop some hotspots, in the last episode. Let's get on to it.
Yeah.
So, Vishy, what do you like to talk about? Regional Victoria.
Regional Victoria,
Or is it regional wherever?
Well,
We'll get to Victoria first.
let's start with the big picture.
Yeah.
Because I want our listeners to understand the context before we get into the specifics. What is actually happening in the Australian property market right now?
Excuse me. So, as most of you all have seen in media, the news, especially on social media, quite a lot of opinions and predictions, projections, whatever you want to call it.
Scams.
Scams, It's uncertain. It's uncertainty. It is what it is in the market. Now, to me, it's like deja vu. GFC, same. COVID-19, when the COVID-19 came, 2019, December, when the outbreak came to 2020, mid-year of 2020, very similar.
You've been investing in the market throughout majority of these big crises.
Yeah. These are the reason the markets are a bit, how do I say this in a way? The why people are saying is uncertain is because they obviously don't know whether it's going to go like really go up in market, like capital growth aspect of it, or the property prices will come down. Right? But what people always tend to forget is the rate of growth. And I still don't understand so much of media we have, especially social media. It's actually about the rate of growth can get affected. And we already seen that, because when things like these happen, negative gearing is going to go away, and only the brand new properties are being given all these benefits. The rate of growth comes down, and that's normal. What happens afterwards is the most important thing you guys need to understand. So there are areas investors have to get themselves familiar with. One is the finance environment. How the banks are going to look at investors, how they're going to service them, what sort of interest rates, right? And what are the other ripple effects coming into play? Rental demand. Is it going to be the same rental market, or will it be more? Will you earn more, or will you earn less? If you want to earn more, which markets are willing to pay more? Right? So now it's the time for you to get yourself educated. If you don't know what's going to happen, you can play in this uncertainty trend, right? It's a trend. You can go with the trend, or you just get yourself educated.
Think outside the box.
Yeah, get yourself educated, have a plan, then execute. That's what I think. It's one of those times in Australian property market. You need to now start looking into different ways of investing. You need to start looking into different ways of borrowing. You gotta really need to open your eyes of how to navigate the interest rate markets, right? So budgeting is something that you really need to spend more time, not just asking your chat GPT to do a budget for you.
Yeah.
You really need to get into it now, right? So
Do some in-depth research and talk to
Absolutely.
some experts.
Yeah.
All right. So now a little bit about the metro property markets, right? So we're building nowhere near enough homes at the moment, right? The rental market is incredibly tight. And regional Australia actually outperformed the capital markets on price growth last year, right? Now that's the context. Now let's talk about the shift that's happening. Why are more investors specifically looking at regional markets right now, including yourself? Why regional? Why the investor shift towards regional markets?
So when you look at the acquisition price or the entry point to a property market, regional markets are cheaper. Right. So you're not going to expose all your borrowing capacity into one property. You can now expose maybe 70%, 60% of your borrowing power into a regional market and buy an investment property. Get it rented out. Usually these days, the yields in regional markets are above 6%. So if you structure it right, it's not going to be even a negative cash flow investment. It can be even neutral cash flow or even positive cash flow. 6 months ago, we were talking about near impossible to get a positive cash flow property because all the energy, all the focus were on metro markets.
Metro markets, yeah.
Right now, all of a sudden, we see the positive cash flow markets booming. Or booming is not the correct word. They're being highlighted, right? Because there are areas that you wouldn't have even looked at it when you were investing. I'll give you a very simple example. Investors are investing in Clyde North, which has done very well. Pakenham, Officer, on southeastern areas, right? Then we go to West Werribee, Manor Lakes, Fraser Rise, right? And then you go to North, Mickleham, Kalkalu, Donnybrook suburbs. You know, there's a lot of, the list goes on. They were doing very good because first home buyers are buying.
There's a lot of own occupiers moving to those suburbs, right?
Yeah. So a lot of options to select, and the rental demand was also there. So you tend not to look at markets like Wendigo. You tend not to look at markets like Wollongong in New South Wales, right? You tend not to look at market like Swan Hill, right? Warrnambool in Victoria, right? And then you have, matured or regional markets such as Ballarat, right? You tend not to look at them. But then when you come into this kind of an environment, now you all of a sudden start doing your numbers. You see, okay, wow, my acquisition price is less than 600,000 total price. In some cases, less than 550. But my rental income is about 650, 700, 750 per week. Any person who knows how to put income and expenses into an Excel will work it out. Oh, okay, I'm making $50, $100, $150 a month. It's a positive cash flow.
Yeah.
Right. So this is why it's a good time to actually really get into those kind of markets before it becomes
For everyone's
neutral cash flow or negative cash flow.
Yeah, exactly.
Because developers are not going to keep it forever for you, right? You might be able to buy $150,000. You put $150,000 to buy a piece of land now. 6 months later, same developer will be selling that close to 200,000.
Now, with all that being said, Pramu, people can't just take this advice and go look at the map, pick a random regional suburb and invest in that suburb and expect it to give them a good outcome, right?
Yeah.
So, I mean, because a town can look affordable on paper and still be a terrible investment.
Absolutely.
Right?
Yeah.
But there are a few indicators that property investors look at when they are looking into a suburb to invest in or a regional market to invest in, right? Now, 5 such indicators are population growth in that suburb, the type of diversity in terms of employment in that area, the infrastructure investments, right? Vacancy rates and rental yields. So I'll ask you to elaborate on each of these points, and if I missed any that you usually look at, which is not in this list, you can enlighten us there as well.
Yeah, absolutely. So
let's start with population growth.
Okay, so population growth is always a factor when it comes to regional markets.
Yeah.
Right. So population grows, what brings? Jobs. When the population grows, infrastructure development.
Yeah.
Local governments, state governments, and federal governments investments coming in.
Yeah.
The reason the population growth is happening not because they are having more children in the houses.
More people are moving.
People are moving in
for employment.
For employment.
Yeah.
Right. So you have to understand what is this population growth is, first of all. So then that will also shows you the industries that are currently booming and what will also happen in the future. When I say in the future, it's not 10, 20 years later. Look at what's happening in the 5 years term. If there is a hospital being under construction or redevelopment of a hospital, what does that mean? That means they're going to bring more doctors, more nurses, different types of medical professionals coming in.
Yeah.
So then you have to look at what are the other industries going to benefit out of that medical industry, transport industry.
Then they need to buy vehicles.
Right.
They need to buy clothes.
Exactly.
Restaurants.
Then you're going to go to motor mechanics. They're going to have business there. Warehousing, Bunnings, Coles, Woolies. It's a web.
And on the off days, they're going to need to do some extracurricular activities or,
gyms.
Yeah.
So small business opportunities are going to pop up in regional markets. So when somebody goes to a regional market with a small business opportunity, what does that mean? Their entry point is lower. That means they're going to profit more, which means they're going to grow that business, which means they're going to create more jobs opportunities.
Yeah.
Right. That's what happens when you grow more jobs.
Yeah.
So when that happens, what happens to the economy? There's a lot of income coming in, or income is generated. Taxation is going to come into play, which is good for the government. Look, you have to understand why these things are happening as well. Because it's a revenue stream for the government.
Yeah.
Government is never going to shut down a revenue stream just like how they did it at mining. Because this is a sustainable revenue stream. It's not like people are going to expire. People are going to reproduce. Right? So Australia has this concept.
Fun fact, Gen Zs are not reproducing as much as you millennials did, but that's a off the topic fact.
I'm pretty sure they'll figure out the ChatGPT or the AI to work it out a way to reproduce when they're ready. But what it does is job security comes in.
Yeah.
Right. So you have to look at the macro side of the market first.
Yeah.
To understand the micro levels.
And this creates demand for places to rent as well, right?
Absolutely.
Because not everyone can buy a property.
So all these doctors going to come.
Yeah.
All these nurses. New business. Give you simple examples like Domino's franchise. Right. And panel beaters.
Yeah. Cleaning.
It's not all the local people are going to start doing that, right?
Yeah.
It's not. So the new guys are going to
whoever
come in.
sees
They're
an
going to start
opportunity.
doing that. So they need places to stay. They also want to invest, which means they want to buy their first home sometimes. Right. I'm coming back to the medical industry here.
Yeah.
A doctor will start their salary about $120,000. In about 1.5 to 2 years later, they're at 200,000. That means now they need to work out how to mitigate the taxes or get better tax benefits. So they will start investing. As a human factor, if you look at it, if you're comfortable in an area that you're already in, you're going to invest there first.
That area, exactly.
Right? And this is exactly what happened to Ballarat. Ballarat went way too fast as well, because all our investors came into a place at the right point when the Ballarat just about to start.
Just before that rocket took off, and then
I remember my first set of investors. We bought it. What's that? 370,000, 380,000.
Winter Valley.
Winter Valley. Right. That was a start. So it went up to what? I think now some of the investors are selling the properties at about 720, 710. Some at 750 too.
And these are big blocks of land as well.
Yeah, exactly. So if you get to go into those developments at the early stage, your acquisition cost is much lower. Your demand of rent is much higher, which means it's positive cash flow. And the rate of growth is far greater. So your investment perspective, if you really look at it from all sides, going to regional markets is safer if you're looking for safer option. That is my opinion. The reason I'm telling you my opinion, because I have done this in multiple regional locations for myself, not just for the investors.
Yeah.
Right. So Morwell, as an example, one of the best investments I have done. Ballarat, my God, very good. Right. So I can keep on telling some of the regional areas I have, but it's me. I'm benefiting out of it. And also the investors who followed me, who also took the advice from our property advisory firm, they're benefiting already. So I'm telling you right now, you have that opportunity in the market to certain locations. I'm not going to give all the locations, but I will give you
one.
You want me to give you one or two?
I mean, we'll give one. They want to know the second one, reach out.
All right, done. Okay. All
right.
Okay.
You scratch our backs, we scratch your back.
Okay. Right? So you want to go down the scratching back?
I mean, an apple for an apple,
Okay.
All right. So these are a few of the clear indicators.
Yeah.
And like you explained, they all work together hand in hand.
Yeah. And then you mentioned other things such as, I did touch point on those very quickly. Yields are much higher.
The rental yield,
Rental yields are much higher. Right now
and also vacancy rates.
Vacancy rates are much lower. Right now, today, for an investor, I was looking at some vacancy rates before the meeting. I was blown away to see the 0.4%.
Is that the suburb you're gonna?
Yeah, that's exactly the suburb I'm gonna say, because it is going that quickly, and I will also say why it's one of those good times to get into the market,
because there's not as much hype around it yet.
A lot of people know about it, but I'm a bit worried now if I say this. But
you already bought your property.
But that's fine. We'll go down that path. But the vacancy rates are lower, which also adds the rental yields being higher at 6.6% in Victoria. Right? And the locality of it, the location of that suburb. Multiple industries already benefiting and operating and creating jobs. So it's a secure location to invest right now. So that's one of the regional pockets that you can really, really benefit. So if I had to drop the name of the suburb
not
right
yet.
now,
Let's Let's build up some
Okay, he
anticipation,
wants to build more. All right, let's
as,
build it.
as this episode
Okay.
progresses on, you
Yeah.
know.
Done. Done. What do you want to talk about else? What are the other things you want to do?
So a town could score highly on yield, right? But be a single industry town, and you'd walk away. Or it could have booming infrastructure investments, but vacancy rates through the roof. So you need a full picture of an area before you invest.
Yeah.
Right? Now let's get specific. You've been talking about, and this is going to be the suburb reveal. So you can, you've been talking about
Swan Hill.
Swan Hill.
Yeah.
Right? As a case study recently.
Yeah.
Right? So the numbers there are pretty interesting. So are you going to break down these numbers for us?
Why don't you break the numbers? I know you've done the research.
Okay, I'll break down some numbers, all right? So this is for Swan Hill based on the case study that you shared with me, Pramu. So the median house price is approximately 490,000 to 499,000 to 500,000.
Yeah.
Right? The gross rental yield is between 5.5% to 5.7% per house. Right? Vacancy rates are sitting between 0.3 to 0.9%, which is extremely tight. Right? Right? Your median weekly rent is around $480 to $500 a week for a house, for a 3-bedroom house.
What's the rent? Median rent?
$480 to $500 a week.
Yeah.
Right?
Yeah. Yeah.
Your median rent has increased 8.7% over the last 12 months.
Yeah.
In that area.
Yeah.
A 3-bedroom house averages 9.6% per annum.
Capital growth?
In terms of price growth.
Yep. Yep. Okay. Right. So you pull these data from where?
CoLogic.
CoLogic. All right. So that data is easily accessible. Now, these data is correct. I'm not saying they're wrong. But do you know the actual data? Actual numbers? These are median numbers collectively taken in different time zones.
Yeah.
Of the markets. You got to look at exact time zone you are in.
This is basically like a tally of all those.
Yeah.
Yeah.
Whatever, 3 years ago to now, it's coming. Right now, your median price is between 580. It's a range. I'll tell you why it's a range. 580 to 650. So 580 is pretty much your 3-bedder.
This is rent, weekly rent.
No, 580,000.
This is brand new.
Right.
For a brand new property.
Yes. And then your 4-bedders are at about 650. Your rental right now in the market, you probably have about, I think you have, when I checked yesterday or today, yesterday night, you only had about 7 properties to rent. Out of that, there was only 1 property for, which is a brand new property for rent, and they were asking $800 per week.
Yes.
4-bedroom house. And that house was bought by an investor, not one of our investors, whoever investor obviously is putting it to rent.
Yeah.
He bought it at $780,000. Size of the land was about 780 square meter block. 4-bedroom house, 22 squares house. Mind-boggling the numbers are. So now imagine an investor goes to a market like that, build a brand new house, put it to the market, 4-bedroom house. What are you going to put it out to? I mean, you can definitely charge, go for 800 premium, but just make it simple, do it 750.
Yeah.
Right. So some of the investors from Swan Hill right now who bought from us, they bought everything under 600,000 4-bedroom house. Everything under 600. And the land price is constantly going up because investors and certain types of owner-occupied buyers are moving.
Yeah.
They're realizing, I can borrow this. I don't need to wait market is getting hot, I'm going to get into this property.
Yeah.
Even if it doesn't work out, I can just rent it out and move on to parents' house, wherever. I'm not going to be paying a rental, or what do you call the out of pocket to hold the property. So if you do very simple numbers, Vishy, right? So let's go $700 per week. That is $100 a day. $36,500 per year rental income. If you buy a property for 600,000, you borrow. Was that let's say you borrow 80%. Actually, let's even go even more. Let's go. You borrow 90%. 540,000 you're borrowing, right? So 540. What's the current interest rate these days? Interest only, I think we would look at. I think it's about 6.5% interest. Interest only, as an investor.
Yeah.
Right. Probably higher, but let's say 6.5.
Good.
Right.
Yeah, best case scenario.
Right.
Yeah.
Your monthly, not a month, your annual interest is 35,100, where you are earning 36,500. What is that? That is $1,400. Your positive cash flow. What can you use that for?
$1,400.
I mean, you will use it for your council rates or water rates or whatever, right? Now this is a brand new property. Government start giving you depreciation on the property, which is average about $12,000.
Yeah, and also with the new budget, as an investor, you buy a brand new off the plan house and land property, you benefit from negative gearing as well.
Exactly.
As opposed to buying an established property.
So you're at a positive cash flow level, but then you can negatively gear it because you're gonna add your council rates, water rates, insurances, your whatever, right? Depreciation coming into play. So all of a sudden, your net income before you bought that house will be increasing close to about $7,000 of a tax return, 7 to 10K tax return. So your net income goes up by 7 to 10K. As an average punter in Aussie,
yeah,
your income only increases by 3.5%. No?
Yeah.
So if you are earning $100,000 income, now your net income has increased by more than 7%. Thanks to an investment that you have done it in a smart way. So when savvy investors understands markets like this, they won't hesitate, they buy. So when you look at the whole the whole market, the whole media, the news, everyone is talking about uncertainty because of the Labour government, because of this government, because of Pauline Hanson might come into power, right? Uncertainty.
Yeah.
The savvy investors don't listen to those.
Now, one potential assumption that individuals are making around Swan Hill is they're saying it's a agriculture only suburb.
Incorrect.
Right? Town. Which is wrong because their economy is actually pretty diversified.
Yeah.
And to name a few, and you can correct me, Pramu, when it comes to healthcare, they've got the Swan Hill District Health Service.
Yes.
Right? Then retail, they've got significant service centers for surrounding towns. So people from surrounding towns actually drive to Swan Hill for their retail shopping requirements.
Yeah.
They've got tourism. It's a tourism hub. They've got the Murray River. They've got houseboats. It's events venue. So during the summer, Swan Hill is actually a pretty beautiful area.
Yep.
Right. Education. They've got multiple schools and TAFEs.
Yep.
In Swan Hill.
Yep.
They've got some renewable energy projects that's actually happening there. They have some solar farms in the area. And they've got logistics, freight and transport hubs for the Murray Murray region,
Mm.
right? So those are a few of the diversified
Yeah.
areas that they have diversified into. It's not just agriculture only.
No. If you look at the investors who's been investing in Swan Hill before, have a look at those data and stats.
Mm.
Self-managed super funds. Not mom and dad self-managed super funds, self-managed super funds, like larger ones.
Yeah.
They've been investing there. Right? Why? Self-managed super fund is not a short-term investment vehicle.
Yeah.
It's a long-term investment vehicle. They've been accumulating good assets with a very low price because your yields are high. Right? So Swan Hill is just one of them.
Yeah, that's and
Right?
we're only
You
going
gotta
to
understand this. I'm not getting $1 out of Swan Hill.
Yeah.
Right? I don't own the suburb or whatever. What I'm saying is this is one of the times that you can go to that market and invest
before it
goes now.
blows up.
If I to give you very simple stuff which I have seen on the job, first investor bought it at total price, land price, bought it at $150,000. Second investor comes in 155. Third goes 160. Right? It's been increasing 5K. So far, this is for the investors that I have seen from my ecosystem. It's gonna keep going up. I have a feeling within the next 2 months' time, these options, these prices are gonna go to 650 very quickly. If you buy it at 570, if you buy it at 580 now, or even 600 now, that 50,000 or 70,000 or $80,000 increment is yours. And I've been telling this every time. Ballarat, I told. Bendigo, I told. Right? Morwell, Mowi. Right? Newbury. 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 Yeah.
I mean, Moe and Morwell are still.
Yeah, they're still going.
They're still good to go.
They're still going. Still
even
going.
even with Bendigo.
Yeah, still going.
Right.
You go now when the land prices are going up. You're gonna make a lot of money as well. I mean, money in the sense you're gonna make a lot of equity for you to leverage if you do your borrowing capacities, if you do your lending structures right, and make yourself ready to invest. When you invest in these kind of properties, it'll enable you to go in the 2 years' time to go and buy more. Sometimes it'll enable you to invest within 6 months.
Yeah. And again, that comes down to your finance structure.
Yes.
Right. Each person's financial situation is different, so they need a tailored financial strategy that works for them. So whether they go with a bank or broker, they need to ensure whoever they speak to, they do a tailored financial strategy for them. Or if they don't know anyone, they can talk to us at TFS. That's what we do for all our clients. So Pramu, coming back to Swan Hill, right now we spoke about the median house price. We spoke about the rental yield, the vacancy rates. But that's all remarkable, that combination. But when you compare it to what's available in Melbourne for the same money, let's shift gears now. Because even if you find the right region and the right property, you still need to get the finance sorted.
Yeah.
So how are banks actually assessing regional investment loans right now?
Look, it's actually, to be honest with you, it's assessed exactly the same way the assessed as a metro suburb. Because banks have already identified these suburbs.
Yeah.
Right.
So are banks supportive of strong regional markets?
Absolutely.
Okay.
We think about it from the very simple risk-taking aspect of it, right? Vishy goes to a bank has no idea about Vishy. We say, I'm going to buy something in Swan Hill or Bendigo. I need the $500,000 loan. Bank don't know about you. They'll just check you from your normal information that you provide, but they'll give you the money.
Yeah.
If you tick all the boxes,
they'll
give you that money. Because they know even if you default.
So what do banks look at when it comes to regional investments.
So they it's all about risk mitigation, right? So we've seen certain types of suburbs banks say we will not lend beyond 70%.
So that's also a good indicator for an investor to think, okay, maybe that suburb is risky.
Exactly. Because banks have already said, no, we are only giving you 70%, rest you have to put.
So because the bank's already done their research on the economy,
Absolutely. They know.
the rates, the vacancy rates, population trends.
Correct. There are different banks might say, no, that's okay, we'll go 80%.
Yeah.
High risk takers will obviously they're going to charge a premium price from you. Right. But it will tell you. So if you speak to when all our investors speak to us and say, hey Pramu, or hey whoever the TFS broker, I want to invest in this location. First thing we do is we put the suburb into our calculations and see what's the maximum LVR the banks are willing to give.
Damita is one of our TFS brokers who's been getting a lot of regional investment clients for some reason.
Yeah. But what he has been doing in a very simple way, putting the postcode into the postcode check and see how much extra you can do or what's the maximum. That will also enable them to add. They're not property advising. They can also enable, the brokers are enabled to actually give them, look, you can only go maximum of 70%. Now the savvy investor will understand, oh, really? So I can't go 80%. Is there any other banks? Nope, that's it.
They can also go with non-bank lenders, right?
They can, but then why do you need to create a positive cash flow property into a negative cash flow property?
Because you get higher rates.
Yeah.
But that option is there for...
Or is it positive cash flow as well? Then they will also start looking into it properly.
Yeah.
Is it really? I have seen I have seen this in some of the investors that we have done mortgages with. They've come, no, this is good. This is growing. Banks say, hey, hang on. Beyond this, we won't give you money. They say, it's okay. We will go Airbnb. We will make more money. Bang, they go. They're not getting the money. Then they realize it while they're investing on, I'm not getting that, which means I'm putting more money. Now it's affecting my cash flow. Negative gearing, negative cash flow. Yes, I'll get some money back from the government, but it is affecting me every month. By the time I get the money, it has affected me for 12 months. 12 months is what? 12 months means 365 days of your lifetime you wasted not investing in a better place that you can actually enjoy. Right? That's the difference. So it's not always buying an established property or buying a house and land or buying booming areas, Queensland, Western Australia. It's not always about that. Sometimes it's about your own sanity too.
Yeah, because if you live in Melbourne and you buy an investment property which is about 4 or 5 hours away from you, it might not give you that,
correct
sanity when you sleep.
Yeah.
Thinking, what's happening to my property? There are people who get attached.
Yes, what I tell them is, look, don't make your decision based on that sanity. That sanity you can live with. Okay,
that's going to cause
because you're not going to live in that investment. So don't. That's an unnecessary thing that you're worried about. But if it's going to really affect your cash flow, that's going to affect your sanity. Right? Vishy, you can only put $500 a month for an investment property. Now, because you've done the wrong investment or because you've done the wrong structure, it has forced you to put $800 a month, which is $300 extra. That $300 you have already planned, $3,600 to go at the end of the year to whatever the country you want to go and have some fun. Now you can't do it. That is where it's going to hit you. That is where people say, I don't like investment. It's pain. I will never invest in property. No. I will only do this. I will only do that. That because they have done the wrong investment in their history. So they are living with those scars.
And scars don't heal.
Exactly.
So, all right, Pramu. So, just to recap what we just spoke about, right, a few minutes ago. So, banks actually look at suburbs, and
Absolutely.
so if you actually have a good broker, you need to speak to a broker first, and the broker will help you identify if a suburb is good or not as well.
Yeah.
If the broker has gone through all bank policies.
Yeah. So at
in that area.
TFS, one of the trainings that all our brokers go through is a property market training.
Hmm.
They all understand how the market works. They've
Yeah.
been always given updates on the markets, right? Even our brokers listen to our podcast. Pretty much.
And shout out to one of our senior brokers, Mr.
Yeah.
Damita Dasanayaka. He's always coming up to us, and he's actually giving us ideas about.
Can you talk about
on that, right? I mean, even this podcast to a certain extent, it's because of some of his clients who keep calling and asking you more information about the suburbs.
About
right? Suburbs.
So the training program is very important to a broker to actually understand the market, not just the finance market. You got to learn about the property market. Once you learn about the property market, you can really give right advice to the customer to do that finance correctly or structure it correctly. Right? I'm not gonna talk about the wrong things other brokers do. I will only tell you what we do. Right?
Yeah.
What I do, what I make sure my brokers, they get to know about the property market, they understand it. They also listen to the podcast. They also go and learn more, right? Educate themselves every single time, updates. So then the output of the finance because of the updates. Right. So understanding that is very, 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 very important. So that's why we're not doing small numbers, we're doing good numbers. That's why people want to do things with us, I suppose. Right.
I mean, there's a reason we're in Victoria's top 15 brokerages every year, right? AFG awards.
That's I don't know how they, but it's but the loyalty. That's what matters. You understand what I'm saying?
Yeah.
The customer loyalty.
So, Pramu, okay. Now in the car, now we spoke about how properties in Swan Hill are positive cash flow, whatnot, right? But in the current market rate environment, right? Should investors be prioritizing cash flow or capital growth?
Current market,
because traditional people chase growth. Now has that changed in this current market?
Cash flow and capital growth. If you can have the both, have it.
Yeah.
I mean,
what's the mindset like now? Okay, let's take you.
But it's very hard to do it, by the way.
Yeah.
If you don't have a mindset to go to regional markets. If you're gonna stuck yourself, if you're gonna stuck yourself in metro market, you're not gonna have the cash flow.
You want to lose it.
Because your acquisition price is higher. So therefore, it is impossible to have a cash flow unless the rates goes down back in the day about to 1.99% or to 2.5%.
Yeah, I don't think we'll see days like that anytime soon.
That will never happen.
This rate,
that will never happen, right? So you're not going to get them, the both together. So if you want to invest, pick the one that you really like, and also understand the one that you really don't like, and know
that's why
you don't like it.
And it comes down to what we always talk about, do the numbers on whatever investment you try.
If you really think about it, cash flow versus capital growth, most people will go with capital growth because they will think capital growth is where I'll make $1 million.
Yeah. Because it's a long game.
It's a long game,
right?
But they don't do some of the numbers such as capital gain tax by the time you actually sell it. That is where the structures comes into play, right? So again, it's I can't actually give you an answer just like that saying
Yeah.
You know what I'm
Cash
saying?
flow, yeah.
Yeah, it's a very hard question.
What do you like?
I like both.
Yeah, I mean, look, yeah, cash flow, capital growth. It's good to have a mix of both. You need both.
I mean, you can contemplate it. Let me put it this way: when I'm doing it, I'll have some of the cash flow positive properties,
Yeah.
cash flow negative properties. I offset it.
Yeah.
Positive will pay negative.
But for someone who wants the best of both worlds, like you said, regional markets are currently the place where both are genuinely achievable.
Yeah.
Right? So let's talk about the other side of this, the mistakes. Because we've seen people get this wrong. What are the three most common mistakes investors make when it comes to looking into regional properties?
They think they can subdivide the property into 10 lots and make a killing out of it. Number one mistake. So they buy a bigger land. It's regional, I need a bigger land. I can subdivide it later, but they don't have a $50,000 extra to even pay the town planner to subdivide it.
And also there's restrictions around subdividing.
Yeah. So you can't rent it. You're not getting the rent that you're supposed to get, because in the old house, big land, so much of expenses, so your rent is gonna come down.
So basically those people are following the hype.
Yeah. So they want to do a metro strategy in a regional market. It'll never work. Right? Mistake number one. Mistake number two, they think market is paying $700. Let me push it for $900 per week. I have 5 bedrooms instead of 4. Their 5th bedroom is that extra living room that they convert to a 5th. It's on the market, not making money. You're paying, then it becomes, I will never invest again. This is a wrong investment.
Yeah, because I mean, even when someone goes on the market to look for a place to rent, you're going to filter your search based on price.
Yeah.
you know?
Yeah. So the simple fact, don't be greedy.
Yeah.
Third one is the most interesting part. Third one is where a lot of people try to overcapitalize in a regional market. They say, okay, I want to buy a 500 square meter block, but I want to build a big double-story house. Big no-no.
Yeah.
Big no-no. So you're not gonna get the money back.
I mean, truth be told, Pramu, we've seen all these 3 scenarios play out, right? And we've seen them play out badly. And the brutal truth is they're all avoidable with some upfront discipline.
Yeah.
Right? And proper guidance. Now, let me ask you something a bit different. Technology and AI have changed so many industries.
Yeah.
You know? And
it's changing.
You're becoming a maestro of AI.
No.
Right?
I'm still learning about this thing.
Right? How is this changing the property investing market specifically? In terms of, because there are so many tools that people can utilize now.
Simple things, right? Before you get to the advanced level of using AI to do analysis of the suburbs, analysis of your builder, analysis of, I mean, there are even more advanced level you can go. Use AI to simplify your investment, right? Get AI to look at your current situation and tell AI, looking at my current situation with your probabilities and projections in certain information and data that you can access, can you give me a plan what I should do? It might even tell you don't invest. So then don't just take the word of AI. Then look at the stats and facts that AI come up with. Ask why you did it. How did you came to that conclusion? Or another thing, when you start on AI, get the AI to do some updates of your properties. Maintain an Excel sheet of your properties. Are there any ways I can improve the property, my existing portfolio? Am I doing certain things wrong? Diagnose it. Right? We used to get paid for these diagnoses.
And also, with some people, using AI, the term analysis paralysis.
Yeah.
Some people go too in depth with AI that even the AI gets confused and ends up confusing them, and they don't know where they started and where they ended up.
Yeah.
So
It'll
you
take
just
you
get
to
carried away.
Yeah, you got to stick with your program. You got to stick with. You got to have an objective. What I need to do. What's my prompts are. Your prompts must be correct as well. By the way.
Yeah, because guys, ChatGPT is only as smart as the person using it. So
Yeah, you have to be very, very careful there too.
Yeah.
But if you use AI into managing and diagnosing your current portfolios, you will be able to advance yourself from that point onwards.
Yeah.
Because you will understand how it works. You will understand what types of prompts it needed. Because AI can't lie to you because you know exactly what you have, right?
Yeah.
In your pocket, if I'm the AI, I tell you, okay, you might say, well, Pramu, what do you reckon? What do you think I have in my pocket? What? If I say, I believe that you have this amount, and if you go this, AI can't lie to you. You know exactly what you have. So start from there first.
From what's in your pocket?
Your platform, your domain. Start from that. Right, I'm giving now AI advice as well. I'm not.
No, I mean, look, we need
Look,
to. Our podcast is very diverse. It's not just property and finance.
But using AI into finance, using AI into investment and property, I think it's a must. Because I'm teaching my kids already about it, how to do it.
Yeah, and how old are your kids?
Right, it's 7 and 12.
Yeah,
both of them 8 and 13.
Yeah,
we sometimes on our way to school we actually talk with AI. We do tutoring with AI. So what I'm teaching them is to use the AI in the right way. Tutoring means you learn, you ask questions what you need to learn. Don't ask things what you don't know and just say, oh, AI told me this.
Yeah.
You'll never ever become successful in your life. Right? Because when they grow up, they have to come to my business. They need to do these things in my way, in my domain. They might do it in their own way, but they got to understand the fundamentals, how it works. Right. So same thing goes to investors, property investors into shares. If you're looking, getting into businesses, right? Now come on. How long does it take for you to do a business plan now? Accountants used to get paid for this thing, right? Simple. It's a revenue just gone, just gone. Yeah, I will do it for you. So learn how to use it.
Better in some
much better than an accountant.
Instances as well. All right, Pramu. So we've come to the end of this episode.
Okay.
Been very insightful.
Yep.
Quite a long episode as well.
Is it?
From our usual? Yeah, it's about 53 minutes.
Oh, wow.
50 plus. But
I didn't know that.
As always, before we end the episode, to recap, now this episode we spoke about regional investment hotspots and why invest in regional markets, what to look for, how to structure your finance, the importance of speaking to a broker, right? And also, banks can also give you some inside information. Clues, right?
Clues.
But to do that, you need to speak to a good broker.
Yeah.
Because you don't have a good relationship with the bank, but the brokers do.
Yeah.
Right? We need to leave our listeners with some Pramu pieces of advice. So 3 pieces of advice.
You're putting me on the spot, mate. All right. Okay. Specifically
for regional property investors.
Right. Okay. I think the 3 mistakes I told you.
Yeah.
Right. Go back to that.
Yeah.
Write it down on a paper.
Yeah.
Don't do them. Okay. Advice number 1.
Yeah.
You can thank me later whether you do business with us or not. I don't care. If you meet me somewhere, you can say, hey, mate, thank you.
Yeah.
Thumbs up, whatever. Don't get carried away with these regional investments that you're going to double your property value. Please don't get carried away. Plan it. learn it from the year one, what I need as a return on investment. Year 2, year 3, year 4. Do I need to hold it for 5 years? Compounding growth, you got to learn what is compounding growth. Then go to regional markets. Number 2, you got to use local agents to rent your property out. Please do not use your metro agent who's renting all over the place in metro. I've seen agents who have a property in Clyde North, Mickleham, Werribee. My God, I don't know how he or she is gonna travel like that to manage those properties.
Yeah.
Right. Don't you do that? Please have a local agent who understand the local market, who understand the language, who understand the lingo of a local person. If you happen to have a local person as your tenant, right?
Yeah.
Third one, an advice.
Go to church.
I don't think that'll help you to get into the regional markets. Maybe. Regional markets. My last piece of advice for regional markets is very simply, go and read the councils, that particular local council investments, or what they're doing, the communities, what kind of things are happening in that area. Are there any festivals happening? Learn the regional language. Don't just become an investor.
Yeah.
I've got a property there. But if somebody asks you a question, do you know in Barat they had this festival the other day? I said, I didn't know. The reason I'm telling you to know these things, because it will give you so much of information and data of the type of investments, type of properties, type of businesses as well, that you could actually invest in those regional markets.
Yeah.
Knowing the local, getting yourself into that local market to understand the way they work, the way they speak, it'll help you to make your next investment in the correct way. Is that good?
That's good, Pramu. And also, since you said that, I've got this saying that I cooked up in my head.
Okay, he cooked something. Here we go.
Don't wait for perfect.
Uh-huh.
Build the strategy. Focus on the fundamentals.
Ooh, that's very powerful. I think we should use that.
Yeah.
You just cooked it?
Yeah, I cooked it some time ago, but it's been goes well with this with everything you just explained.
Yeah.
Right? So there you go, guys.
That's amazing.
Regional Growth Hotspot episode. So with that being said, thank you guys for tuning in to another episode of the TFS WealthCast podcast, and we'll see you guys on the next.
Thank you.
Thank you for tuning in to another episode of the TFS podcast, where we turn knowledge into action and big goals into real results. Now, don't forget to like and subscribe and share this episode with someone working towards their next financial step. Now, with that being said, until next time, keep building.